Are you worried about a possible stock market crash in 2022? What are the strategies that successful investors apply to survive market crashes and collapses? And how can you make a profit during a stock crash in 2022? Well, you will find answers to these questions in the video. There are 5 risks that you should definitely avoid when the stock market is crashing or having a bad time. Well, investors do not agree on much, but most of them definitely agree on avoiding these risks during the stock market crash, whether in 2022 or beyond. The S&P 500 earned almost 27% last year, much exceeding its average yearly performance of 11% since 1980. But as the past has shown, turbulence, collapses, and adjustments are a natural part of the trading cycle and the cost of entry to what is perhaps the world's biggest wealth producer. Unfortunately, during bull markets, investors tend to pump money into stocks after they have been climbing for a while and news has been exaggerated, as though nothing could be bad with the markets. Some modest retail investors stack on because they don't want to miss out. After the tiniest sign of a correction, the same one panics and bails out. By the way, YouTube studies have shown that you can avoid panic by smashing the like button. So, with that being said, let's start with number 1, don't sell in a state of panic. During market downturns, it may appear like selling your holdings is a good option. Any investor can be influenced by false news, as in a pandemic, a property bubble about to break, frauds being exposed, and so on. Market gurus, on the other hand, claim that the stock market's finest and terrible days are frequently close together. This is the main reason why most average investors fail to profit from market timing strategies. The important thing to memorize is that fear causes panic, particularly among novice investors. During a share market meltdown, this panic typically causes investors to sell their shares at low prices. We're programmed to flee danger at the first sign of it, which is precisely how a market meltdown feels. This attitude is understood by a fear-based motivated reasoning known as loss aversion. Of course, knowing that not all equities return after a market meltdown can make you nervous. Buying extremely high and selling cheap, on the other hand, is a losing strategy. So, a more pressing topic is how we might better regulate this emotion to avoid panic selling and instead take advantage of market declines, inherent possibilities. Regardless of market conditions, maintaining your feelings in control will assist you to make more reasonable decisions. The market has consistently rebounded in the past. It's important to note that I mentioned the market, not a specific stock. As I previously stated, while some equities will return to the market, others will not. This makes the commodity you invest in all the more important, so you can rest easy during market downturns. By the way, the market came back quickly after the individual investors I described earlier left, with S&P 500 reversing an earlier 4% drop and ending most of it in the green. The share marketplace is like a roller coaster ride, and getting off in the middle of a trip doesn't sound like a good idea. Number 2. Purchasing the dip isn't always the best option. It is crucial not to make panic buying in a market crash, just as important not to make hasty sales during one market crash. Panic buying is a frame of consciousness that encourages you to make haphazard investments, which can obstruct your progress towards the present investment goals. After all, it appears that the greatest moment to invest at fair valuation is when the markets are down. In such instances, investors frequently purchase blue-chip stocks or index funds. In such instances, however, many investors overlook one important aspect of equity investing: their risk appetite. When markets fall, a buying frenzy might cause people to invest in equity much beyond their risk tolerance. The market is presently in negative territory. Geojit Financial Services Chief Investment Strategist V.K. Vijayakumar said, "Investors must exercise caution. Energy is quite secure due to high energy costs. Metals and relatively safe owing to excessive global pricing, and export segments are relatively safe due to strong market and rupee devaluation. In the aforementioned sectors, calibrated purchase in very small amounts may be considered." Number 3. No new stocks should be added. Don't add any goods or products to your portfolio because they look to be inexpensive at this time. Remember that even if a stock's price has dropped 50% from its peak, it might still be pricey if its financials aren't in excellent shape. Keep your basic and old stocks on hand and wait for the proper opportunity. Always consider your options before acting. Never try to be a hustler. Is it okay to purchase fear at this moment, or would that be too early? It is debatable. Let's assume that what's going on doesn't go on for too long. When looking at previous conflicts or circumstances like this, the market normally tries to rebound after the event, because there are two perspectives to consider. One option is to wait for the uncertainty to pass and then purchase when it appears that it is virtually gone. Or you may start slowly and surely because it's difficult to predict how long it will persist and what other casualties we might see as a result. Number 4. Don't invest in stocks in specific industries. As a savvy marketer, you should also invest in assets outside of the stock market to maintain a steady cash flow even if the stock market collapses. The impact of a stock market fall might be mitigated by diversifying your income portfolio. When the share market is profitable for you, we recommend that you accumulate more and more assets. After the share market crisis, having a steady income ensures financial stability. Begin building a solid and more broad income strategy that excludes the stock market today. Don't put all your eggs in one basket, Warren Buffett once said, and we recommend that you do the same. Portfolio flexibility is essential during one stock market crisis. Yes, many stocks can go down in price indefinitely at some time, but the prudent investor will avoid them or hold them in sufficient numbers to make them unimportant. New investors, on the other hand, should seek assistance because they may not have adequate expertise with what to do during a downturn. First-time investors should cooperate with experienced consultants and engage in good top-notch companies obtainable at reasonable prices in tranches, said Nishit Master, portfolio head at Axis Securities. They should also refrain from using leverage. Number 5. Make a strategy plan. We can still lose despite our greatest efforts. Many things in life are like that. Being married or having children are both fine examples. No matter how well-intentioned we are, many here might fall short just when we need to have things in check the most. Investing is no exception. I already discussed how your personality is the single most important element in your portfolio's performance. There are numerous strategies for combating our inherent weaknesses and avoiding the traps that are too easy to fall into. When it concerns planning for a stock market crash in 2022 or beyond, I believe journaling is the most effective instrument. Market crashes are nothing to be afraid about. They are inescapable and a necessary trade-off to reap the benefits of the exceptional returns that public equities can offer over time. Recognizing your stock market background and identifying how much pullback you can handle, having enough money on hand, having to build a portfolio that matches your risk profile, keeping a wish list of favorite businesses you dream of owning in a market sell-off, and jotting down your strategy will all help you weather the next market crash. Most importantly, you will strengthen yourselves to be true long-term investors, unaffected by the volatility of the stock market in the near term. Remember, you are a born winner. In order to win, you must prepare to win, expect to win, and click the subscribe button. So, if you stick it out through the hurdles the market will toss at you, it'll most likely be a very gratifying experience. Although the trip may not be easy, it will be worth it.